Stocks are in the green across the board now. The Dow rebounding from last week's slide. And my next guest says she's staying cautious when it comes to equities, saying the risk reward going into the second half is not that great. Let's bring in Elizabeth Burton of Goldman Sachs. Welcome. It's nice to see you.
Hi, Scott.
Nice to have you on the program. So why isn't it so great right now?
So I don't think we're saying being underweight equities overall necessarily. You don't want to change your portfolio, but the risk reward, particularly for U.S. stocks, looks a little bit fat and flat from here through the end of the year. Yeah,
what leads you to believe that? Is it in part just because we've had such a big first half that we've kind of done a year's worth of gains in 6 months?
It's mostly earnings driven. I mean, these next couple of weeks will be interesting to see what was going to come out of the second half of the year. But we only see slight increases from here through the rest of the year. We see margin compression happening, so it'll be interesting to see what we hear on the consumer front, from AI, from credit, over these next couple of weeks.
This is like the great debate right now as to what degree do earnings have to be good enough for investors to say, okay, that's fine. They were better than feared. And there's commentary on the street, which I already referenced in earlier conversations, that that's not good enough anymore. That got us here. Now it matters that they really need to be good. Do you ascribe to that, or what's your thought there?
I think what's important to think about in that question is there are alternatives now, right? So yes, earnings need to be material if you can also allocate to cash and earn a pretty healthy risk-free return. You've also got the bond market to contend with, and you've got alternatives coming back. If you Googled hedge funds in 2017 to 2021 in your filter, you'd see comments like hedge funds are dead. You don't see those anymore. There are more opportunities in the market to be long and short in different parts of different asset classes.
So we've talked about the competition for equities for some time now. You still think that exists? I guess what's the level of conversation that you're hearing from big allocators of capital, hedge funds and other institutions when it comes to that? Do they still see competition elsewhere that just provides, enough reward with less risk?
Competition in terms of where else to look in the equity market, or competition from asset classes?
Competition in terms of asset classes.
Sure.
Why bother taking the bigger risk in equities when I can take less risk with cash equivalents, money markets, and treasuries and things like that?
Right. Well, I think for pension funds specifically, they have to stay invested in equities in order to achieve their 6.5% to 7.5% long-term returns. But how can they do that in a way that might decrease their risk? Well, it's difficult to lower the beta or the market risk of that portfolio, particularly when we're in a growth-sensitive environment. So one of the ways you can do that is through long and short trading, hedge fund strategies, or looking in equities in other parts of the market. So private markets, moving to active management, or looking out of the U.S., where you get less exposure to some of these well-performing but large big tech names.
Would you still be overweight bonds relative to stocks, or no?
Right now, we believe that you should be underweight bonds in general, or underweight high yield, I should say, and neutral on bonds in general. Underweight maybe U.S. equities, but there's opportunities to look abroad, look elsewhere. Neutral in general in equities. You want to be tactical, but where you can be overweight would be commodities and cash. And I like to think of the overweight in cash, which is typically difficult for some of our larger investors, as sort of being able to catch a rebound so that, when someone's free and open, you can get another shot on goal, particularly when that's paying you to do so right now.